The first thing most people would do if World War III started tomorrow is open their brokerage app. They wouldn't call their mom, they wouldn't check on their neighbors or secure their property. They would immediately open their brokerage app, terrified of losing their money. That is exactly what acute financial anxiety does to you. It completely hijacks every primal survival instinct you have and redirects it toward a digital portfolio that, in the grand scheme of a global conflict, probably does not need your help right now. And here is where the reality of the market gets incredibly dark. Because while you are doing that, while you are panic selling your index funds at 6 a.m. and congratulating yourself for being proactive, someone else is doing something that looks completely insane. They are buying. They are not buying randomly, and they are not buying recklessly. They are executing a predetermined strategy in a very specific order, based entirely on what actually happens to money during every single war this country has ever fought. What I am about to show you is going to feel fundamentally wrong the entire time I am saying it, because the history of war and money is one of the most brutal, counterintuitive stories in finance, and if you don't learn it today, the next crisis will cost you a fortune. Before we talk about a single investment, we need to establish the baseline truth. I need to introduce you to the people who are rooting the absolute hardest for you to make the wrong decision. They are not foreign governments, they are not hedge funds. They are the financial media. And I do not mean that as some vague, paranoid internet conspiracy. I mean it as a direct, observable, multi-billion-dollar business model. You have to understand how their machine is built. Every single time geopolitical tension spikes, television viewership goes up. When viewership goes up, ad revenue goes up. The more terrified you are, the longer you sit paralyzed watching the screen. Your panic is literally their product. So when the global markets drop 2% on a war headline and the Chiron reads global markets in freefall, you must understand what is actually happening. A 2% drop is a completely normal Tuesday. It has been specifically labeled a free fall because the word free fall triggers a biological response that makes you click. Moderate pullback consistent with historical conflict patterns does not get ratings. It never has and it never will. This matters deeply because the financial media doesn't just report on your fear, it actively manufactures urgency around it. They will find the most alarming, pessimistic expert they can legally put on television. They give that expert 17 minutes of uninterrupted airtime to predict the total collapse of Western civilization. And then, the exact moment you were fully terrified, they cut directly to a commercial for a brokerage platform. A platform that will happily facilitate your panic-driven trades for a small, hidden fee. The entire ecosystem, the news segment, the expert, the platform, the ad, profits entirely from you doing the exact wrong thing at the exact wrong moment. Let's introduce Dave. Dave is a reasonably smart person. He has a stable job and he managed to save $40,000, which he correctly invested into broad market index funds. But Dave has a fatal flaw. He has a toxic habit of watching too much financial news. When Russia invaded Ukraine in February 2022, Dave watched the live coverage for 3 hours straight. His brain was relentlessly bombarded. He saw the word crisis flash across the screen approximately 47 times in a single morning. The psychological pressure was completely unbearable. He couldn't take the anxiety anymore. So, seeking absolute relief from the mental pain, Dave opened his phone and sold everything by 9 a.m. He moved his entire $40,000 portfolio into cash just to feel safe again. Now, meet Kong. Kong had the exact same portfolio size. He experienced the exact same morning. He received the exact same terrifying news alerts on his phone. But Kong operates on historical data, not adrenaline. Kong completely ignored the screaming television anchors. Instead, he read one single mathematically proven data point. The S&P 500 had recovered from every single major military conflict since World War II within an average of 47 trading days. Armed with that irrefutable fact, Kong turned off the TV, he ignored the experts, he left his automated investments running, and he simply went to work. He let the algorithm do the heavy lifting while the world panicked. Everything that follows in this video is the complete documented story of what happened to their money, and the massive wealth gap between Dave and Kong by the end of this crisis is going to make you genuinely angry. Not angry at Dave, you should be angry at the entire system that convinced Dave he was being smart by selling. Because here is the ultimate data point that the financial media will never, ever lead with. If they told you this, it would immediately reduce your anxiety, and they absolutely cannot afford for you to be less anxious. The truth is, markets do not die in wars. They dip. They panic for a few weeks to price in the sudden uncertainty, and then, almost without a single historical exception across 110 years of data, they aggressively climb. Let's look at the absolute worst conflicts in modern human history. The Dow Jones Industrial Average did not collapse during World War II. It gained a staggering 50%. During the Korean War, the market gained 60%. Even during the chaotic, prolonged, and highly controversial quagmire of the Vietnam War, the broad market gained 27%. The data is undeniable. The S&P 500 has delivered positive one-year returns after 73% of all armed conflicts since 1945. Think about what this market has survived. The U.S. stock market has survived 2 world wars, a Cold War nuclear standoff, a global pandemic, multiple presidential assassinations, and a debt ceiling crisis that nearly killed it without a single weapon. At this point, the broad market is basically a cockroach in a tailored Wall Street suit. You cannot kill it, and the suit is doing just fine. I know this feels wrong to hear. I know it feels heartless and cynical to talk about profit while nations are at war. But you must understand the cold structural mechanics of why this happens. Wars are, economically speaking, the most aggressive and immediate government stimulus programs in human history. When a country goes to war, the government instantly stops caring about the national budget. They authorize spending with no limit. Weapons, heavy fuel, global logistics, medical supplies, communications infrastructure, and advanced intelligence systems. The sheer scale of production required is astronomical. All of this production flows directly into publicly traded companies. The government literally becomes the world's largest customer overnight. And here's the secret. They pay whatever the invoice says. That infinite geyser of money has to go somewhere. It bypasses the bureaucracy and injects straight into corporate earnings reports. This is why the market rises. The investors who came out worst in every single conflict of the past century were not the ones who held their portfolio through the storm. The absolute biggest losers were the ones who sold their broad market exposure to get to safety. They cash out at the bottom of the fear cycle, and then they sit on the sidelines holding pure cash, completely ignorant of the fact that cash is losing purchasing power the entire time they wait to feel calm enough to get back in. Let's look precisely at what happened to Dave. He sold his $40,000 in index funds at exactly 9 a.m. on February 24, 2022. The S&P 500 fell 2.5% that specific morning. Dave thought he was a genius, but then the market had already priced in the uncertainty. The moment the invasion actually began, the range of possible outcomes instantly narrowed. The mystery was gone, and institutional capital started moving rationally again. By the end of that exact same day, the market closed up 1.5%. Dave missed the intraday recovery entirely. Traumatized by the media narrative, he sat in an all-cash position for 4 consequent months. By the time he finally felt safe enough to re-enter the market, he had missed the best stretch of returns.
The answer your primitive brain gives you during a market crisis is always, not yet, wait until things settle. The analysts J.P. Morgan tracked this precise phenomenon. They looked at a massive 20-year span. A $10,000 investment left completely untouched in the S&P 500 grew to an impressive $71,000. But if you panic sold out of fear and you missed just the 10 best trading days in that entire stretch, 10 days out of roughly 5,000 trading days, your final return collapses to just $32,000. Here is the killer detail that destroys the illusion of market timing. 7 of the 10 best trading days in any given stretch happen within 2 weeks of the 10 worst days. The crash and the recovery are practically the exact same event. The financial media knows this. They cover the crash breathlessly because it generates clicks. They barely cover the recovery because good news is worthless to their business model. Dave felt a wave of relief when he hit sell. He felt like he took control of his life. That feeling was an expensive illusion. You can know everything in this video, you can memorize the statistics, but you can still make the wrong decision. It will feel like clarity. To survive, you cannot rely on instincts. You need an emotionless framework. You need the anti-fragile war portfolio. The order here matters immensely because each step creates the foundational stability for the next. Step 1. The cash floor. This is strictly 6 to 12 months of living expenses and absolutely no more. He also keeps physical cash at his house. Here's why the physical part matters. When Russia was cut from SWIFT in February 2022, Russian citizens woke up to non-functional ATMs. But here's the critical part. This is exactly where you stop with cash. Warren Buffett said it directly. Holding excess cash during wartime is one of the worst things you can possibly do with your wealth. Wars are massively inflationary. Wartime inflation averages 4.5% versus 3% in peacetime. Every dollar beyond your emergency buffer sitting in a savings account is slowly evaporating. Step 2. Gold. This should be 10 to 15% of your investable assets. Most people's instinct during a crisis is to buy gold immediately because they think the world is ending. That instinct is catastrophically wrong about the timing. The people who bought gold at its January 1980 peak waited 26 years just to break even in inflation-adjusted terms. The people who bought at the 2011 debt ceiling crisis peak lost 30% over the following 2 years. Gold spikes on the fear and then gives back the fear premium. And yet right now, gold is holding incredibly strong because global central banks went on an absolute buying spree, purchasing over 1,000 tons annually. This is massive institutional repositioning. Kong holds IAU for near zero cost exposure. By the time gold hits the front page, he is already positioned, and he keeps a small 5% slice in physical coins. Step 3. Defense. 10 to 15%. This is the trade that wartime history hands investors every single time, and most people refuse to take it because it feels uncomfortable. Profiting from weapons manufacturing does not fit neatly into most people's self-image, but the market is entirely amoral, and the math does not care about your feelings. The financial media actively hides the sheer magnitude of the returns. Lockheed Martin has returned over 1,200% since the War on Terror began. In 2022, the global defense sector outperformed the broad market by 28 percentage points. Right now, the global defense sector is sitting on uncancelable backlogs that would take years to work through. This is a massive, decade-long structural shift in global capital. Kong buys the XAR ETF. It is equal-weighted, preventing you from betting your life on just 2 companies. Step 4. Energy. 10 to 15%. The script never ever changes. A conflict erupts, tension flares in the Middle East, and we see immediate pressure on the Strait of Hormuz. The mechanics are simple. Conflict restricts supply, panic drives premiums, and energy stocks print sheer cash. In 2022, when the S&P 500 lost 18%, XLE gained 64%. It was an 82-point gap. But remember what the media was covering in 2022. Instead of telling you to buy XLE, they were obsessing over the tech sell-off. They conveniently forgot to mention the massive energy sector quietly going up 64% in the exact same year. Energy is the ultimate hedge against geopolitical supply shock. Step 5. Consumer staples. 10 to 15%. This represents the boring, unbreakable reality of human existence. When war breaks out, people panic and cancel their vacations. They skip expensive restaurant reservations, but they absolutely, unequivocally do not stop buying laundry detergent, pain medication, and Coca-Cola. Because humans require caffeine and clean surfaces regardless of the geopolitical context. Kong buys XLP, which holds Procter & Gamble, Costco, and Walmart. When the S&P 500 was down 17% through August 2022, XLP was only down 4%, That gives you 13 percentage points of pure cushion while paying a steady dividend. Consumer staples are the exact financial equivalent of a beige cardigan. Nobody on the internet is impressed by it, but it will absolutely keep you warm during a brutal freeze. Dave mocked Kong for buying boring grocery stocks instead of crypto. Now Dave is freezing to death on the sidelines. The base of the portfolio is completely built, but we're missing the most critical defense mechanism. Step 6, inflation protection, and a massive blinding red warning about the classic safe haven trap that the media loves to promote to retail investors. Every financial anchor will tell you to buy standard long-duration U.S. Treasury bonds when uncertainty hits, because bonds are safe. They drill this into your head from day one. Here is the most counterintuitive fact in this entire video. During World War II, standard U.S. government Treasury bonds lost 67% of their real value. The classic safe haven was literally one of the worst trades of the entire war, because wars are wildly inflationary. The government borrows massively, creates new debt out of thin air, and inflates their obligations away over time. Nominal bonds get absolutely destroyed. If you buy a 30-year bond paying 3% and wartime inflation spikes to 6%, you're locked in a cage, losing 3% of your wealth every single year. The media won't tell you this, partly because it's complicated, and partly because their advertisers are brokerages that make huge fees when you panic trade bonds. So what does Kong do instead? He buys TIPS, Treasury Inflation Protected Securities. He allocates a strictly controlled 5 to 10% of his portfolio. TIPS are mathematically engineered by the government to adjust their principal automatically whenever the consumer price index rises. They literally track inflation. If inflation goes up because of wartime money printing, the government is legally forced to increase the value of your bond. You are forcing the government to cover your inflation losses. You can buy the TIPS ETF, or you can buy Series I savings bonds directly from the government at treasurydirect.gov with an absolute zero expense ratio, no middleman. Series I bonds have a strict 1-year lockup period. Most retail investors absolutely hate this. They want instant liquidity. But the lockup is actually a massive psychological advantage. It is the government forcibly preventing you from panic selling your own inflation hedge when the media tries to scare you out of your position. Avoid TLT and long-duration nominal treasuries like the absolute plague during a geopolitical crisis. They get crushed to powder when the war machine turns on and prints money. Now the tactical satellite positions are firmly set: gold, defense, energy, staples, and TIPS. But the absolute core of the portfolio remains. The foundation of your wealth. The one thing you absolutely, unequivocally never touch. Your broad market index funds. Your VOO, your VTI, your SPY. They are untouchable. The CFA Institute tracked data across every major war. Large cap stocks actually perform mathematically better during wartime than they do in peacetime. They average 11.4% annually during conflict, and remarkably, they do it with lower overall volatility because the war economy is a pure stimulus economy. When the market drops violently on the initial invasion headline, you do not sell, you aggressively buy the fear. You leave your automatic contributions running. If you have a Roth IRA, a crisis downturn is the single best time in your entire life to contribute. You're buying decades of tax-free growth at a massive generational discount. The market crashes, you buy more. You close the app and you do not look at it for 6 months. You completely sever your emotional connection to the screen. You quietly thank yourself later when the inevitable V-shaped recovery occurs and the media suddenly stops talking about the apocalypse and moves on to the next fake crisis. This is the complete anti-fragile war portfolio. It completely removes emotion, it ignores the toxic news cycle, and it mathematically positions you to profit from the reality of government spending.
Now, let's close the story of Dave and Kong with the exact, undeniable mathematical reality, the cold hard numbers of panic versus discipline. So what does Kong do instead? He buys TIPS, Treasury Inflation Protected Securities. He allocates a strictly controlled 5 to 10% of his portfolio here. TIPS are mathematically engineered by the government to adjust their principal automatically whenever the consumer price index rises. They literally track inflation. If inflation goes up because of wartime money printing, the government is legally forced to increase the value of your bond. You are literally forcing the government to cover your inflation losses. You can buy the TIP ETF, or you can buy Series I savings bonds directly from the government at treasurydirect.gov with an absolute zero expense ratio. No middleman, no broker fees. Series I bonds have a strict one-year lockup period. Most retail investors absolutely hate this. They want instant liquidity. But the lockup is actually a massive psychological advantage. It is the government forcibly preventing you from panic selling your own inflation hedge when the media inevitably tries to scare you out of your position. It saves you from yourself. Avoid TLT and long-duration nominal treasuries like the absolute plague during a wartime geopolitical crisis. They are exactly what gets crushed to powder when the war machine turns on and prints money. Now the tactical satellite positions are firmly set: gold, defense, energy, staples, and TIPS. But the absolute core of the portfolio remains, the foundation of your wealth. The one thing you absolutely, unequivocally, under no circumstances ever touch: your broad market index funds, your VOO, your VTI, your SPY. They are untouchable. The CFA Institute tracked data across every major war in modern history. Large-cap stocks actually perform mathematically better during wartime than they do in peacetime. They average 11.4% annually during conflict, compared to the 10% peacetime average. And remarkably, they do it with lower overall volatility, because the war economy is a pure stimulus economy. When the market drops violently on the initial invasion headline, you do not sell. You aggressively buy the fear. You leave your automatic contributions running. If you have a Roth IRA, a crisis downturn is the single best time in your entire life to contribute. You are buying decades of tax-free growth at a massive generational discount. The market crashes, you buy more. You close the app and you do not look at it for 6 months. You completely sever your emotional connection to the screen. You quietly thank yourself later when the inevitable V-shaped recovery occurs and the media suddenly stops talking about the apocalypse and moves on to the next fake crisis. This is the complete anti-fragile war portfolio. It completely removes emotion, it ignores the toxic news cycle, and it mathematically positions you to profit from the reality of government spending. Now, let's close the story of Dave and Kong with the exact, undeniable mathematical reality: the cold, hard numbers of panic versus discipline. Dave sold his $40,000 in index funds on the morning of February 24, 2022. He moved completely into cash. By selling, Dave immediately triggered a massive taxable event. He paid capital gains tax for the absolute privilege of making a terrible decision. Dave then sat in cash for 4 agonizing months while inflation ate away at his purchasing power every single day. He finally re-entered the market in late June, but by then, the index had already fully recovered from its invasion day dip. He was buying back in at a higher price. He completely missed the energy sector running up 64%. He completely missed the defense sector outperforming by 28 points. He captured none of the crisis upside. He locked in the downside permanently via the tax bill. 4 years later, Dave's $40,000 is worth roughly $48,000. He barely survived inflation. Now, look at Kong. Kong did exactly what the financial media begs you not to do. He did absolutely nothing. He kept his original $40,000 fully invested in the broad market. He let his automatic monthly contributions aggressively buy the dip at a massive discount. He held his tactical satellite positions in defense and energy. Today, Kong's portfolio is worth roughly $91,000. Same starting point, same terrifying news alerts, but a $43,000 difference in pure, undeniable wealth. Understand this fundamental law of the market. Kong didn't win because he picked a magical meme stock that went to the moon. He didn't gamble. He won because while Dave was sitting in cash letting inflation destroy his savings life, Kong was systematically buying high-quality assets at a geopolitical discount. Kong bought the fear.
Dave paid for it. So let's go back to that morning. The morning the next crisis hits. The missiles are starting flying, your phone is literally exploding with notifications, the news chyrons are completely blood red, some Wall Street analyst with a $5,000 suit and perfect hair is passionately explaining why this time is categorically different. The person without a plan panics. They sell everything. They feel briefly, artificially smart, and they spend the next year watching the recovery from the sidelines. But the person with a plan does not flinch. Kong checks the structure he already meticulously built: the cash floor, the gold, the defense, the energy, the staples, and the completely untouched, unbothered index funds at the core. Kong puts the phone down, he closes the brokerage app, and he goes to make a cup of coffee. One of these people builds multi-generational wealth. The other person directly funds the media system that was specifically designed to fund them from ever becoming rich. The time to become the second person is right now. Not when the news tells you it's too late, not when the missiles are already in the air, right now. The media completely relies on your financial ignorance. The only way to fight back against the Matrix is to understand the cold mechanics of their manipulation. If this video reframed the way you look at a global crisis, smash the like button into pieces. Break the algorithm that promotes their fear and fake panic. Subscribe to the channel, ring the bell, and join the army of the unbrainwashed. Because unlike the financial media, we do not profit when you are terrified. Stay cold, stay disciplined. See you in the next video.